Diving into the realm of financial freedom often brings us face to face with the vast opportunities that trading and investing offer. Bill Kraft's book serves as a guiding beacon for those eager to step onto this path. It underscores a crucial point. Financial security is no longer guaranteed by high-paying jobs or pension plans alone. Instead, individuals are encouraged to carve out their own paths. Trading, especially options trading, may seem daunting to many, but with the right strategies, risks can be mitigated, leading to success. Bill Kraft shares personal anecdotes illustrating the flexibility and freedom trading provides. Transitioning from a career in law to trading, Kraft achieved financial independence and enhanced his quality of life. This shift not only offered him financial freedom, but also improved his lifestyle. He emphasizes that with a disciplined approach and a solid plan, trading can indeed lead to achieving financial goals. The book delves into the opportunities trading presents for both novices and seasoned investors. By overcoming fears and minimizing risks, financial success is attainable. Kraft's personal story serves as an inspiration, encouraging readers to craft their own financial roadmaps. He highlights the critical importance of risk management in trading, drawing from his seminar experiences that led to significant successes. However, he also notes the importance of risk awareness and control during this journey. When embarking on trading, it becomes evident that everyone must determine their own risk tolerance. This varies according to personal goals, financial situation, and knowledge level. From Kraft's experiences, managing market fluctuations and developing disciplined strategies instead of making emotional decisions is vital. Moreover, the buy and hold strategy isn't always the best option. Crafting strategies that align with market dynamics and personal needs can be more effective. One of the keys to trading is maximizing potential returns while minimizing risks. In the investing world, the buy and hold strategy often seems like a safe haven, yet it carries its own risks. Companies might face bankruptcy or unexpected managerial changes, leading to devaluation of investments. The collapse of giants like Enron and WorldCom exemplifies the dangers of this strategy. Simply holding onto a stock can sometimes lead investors to significant financial losses. Thus, investing should involve not only acquiring stocks, but also planning an exit strategy. Success in trading shouldn't be left to chance. A disciplined approach and a personal trading plan are crucial for long-term success. Risking money requires using only what you can afford to lose. For instance, if you have $20,000 and $15,000 is earmarked for essentials, the remaining $5,000 is your risk capital. Even if lost, it won't adversely impact your life. However, this doesn't mean you should risk all your money. Knowing your risk capacity and acting accordingly is essential. Time management is another critical aspect of trading. Trading doesn't have to demand long hours. For instance, while a lawyer might work 3,000 hours a year, one could enhance their quality of life by trading just 500 hours annually. Setting and adhering to your working hours with discipline is crucial for success. Though working from home is appealing, maintaining strict discipline during these hours to avoid distractions is necessary. When selecting trading strategies, focus on those you know and enjoy. Investors are advised to test their strategies on paper and, upon seeing success, try them with real money. Knowing your risk tolerance and choosing strategies accordingly ensures peaceful nights. Remember, every strategy has a risk-reward balance, so select what suits you best. The ups and downs of stock prices in the investment world offer investors significant opportunities and risks. Even giants like AT&T and General Electric have faced unexpected declines. Therefore, buying stocks in the hope they'll rise can be risky. However, if stocks do rise, the potential gains are limitless. Companies like Nvidia and Akamai have provided substantial profits to investors who timed their investments well. A successful investment strategy should align with your personal risk tolerance. While high-risk, high-reward strategies may appeal to some investors, low-risk, moderate-reward strategies can offer a more comfortable investment experience. Making trading decisions when the market is closed, free from emotional influences, is crucial. This helps investors act more rationally and with discipline. Choosing between technical and fundamental analysis is also critical for investors. Technical analysis, based on data like price and volume, offers a more disciplined trading approach and aids in timing entry and exit points. A disciplined approach enhances trading success by avoiding emotional decisions. It's important to remember that the investment world is complex, and every investor must find their own path. Technical analysis helps separate emotions from stock trading and facilitates more logical decision-making. For example, using the 50-day moving average can help determine entry and exit points. If a stock rises above this average, it might be time to buy. If it falls below, it might be time to sell. This way, one can stick to predetermined strategies without getting swayed by stock price fluctuations. To illustrate with a real-world example, an investor might buy a stock at $30 and sell it when it reaches $50. Sticking to strategies determined by technical analysis rather than emotional decisions increases the chance of profit. Additionally, investors can better manage their positions using charts and indicators. Indicators like MACD and DMI provide investors with clearer entry and exit points. Ultimately, achieving success in investing involves predetermining entry and exit strategies and sticking to them. This minimizes risks and prevents investors from making emotional decisions. One of the most important elements when investing is creating a trading plan and sticking to it. Before starting any trade, defining entry and exit strategies reduces unnecessary anxiety. Indicators are useful to support investment decisions, but can't fully reflect market sentiments. Therefore, focusing on fundamental data like price and volume can yield more reliable results. Japanese candlestick charts are particularly effective in predicting reversals by identifying support and resistance levels. Using limit orders shields investors from market fluctuations. For instance, if an investor buys a stock at market price and the price unexpectedly rises, significant losses can be unavoidable. Limit orders minimize such risks. Additionally, stop-loss orders help investors control their losses. If a stock falls to a certain level, an automatic sale is triggered, allowing investors to manage their positions without constantly monitoring the market. Finally, an investment plan must be flexible. By updating your plan in light of changing market conditions and personal experiences, you can better manage risks and make your investments more effective. Management and strategy are keys to long-term success. Money management is one of the keys to success in the investing world. Most successful investors, like Dr. Alexander Elder and William J. O'Neill, control their risks at specific rates and develop strategies to minimize losses. For instance, O'Neill emphasizes the importance of cutting losses if a stock investment falls 7 to 8% below the purchase price. Every investor may have a different money management plan, but the fact that they all have a plan doesn't change. For those with small investments, trading on a percentage basis can be challenging. For example, for someone with only $1,000 to invest, a 3% risk equates to just $30, which isn't sufficient for most trades. Therefore, accumulating more funds or engaging in lower-risk trades might be a wise option. Besides money management, education is equally important. Improving investment skills is crucial for generating additional income and achieving financial independence. Resources like books and seminars can help you enhance your skills in this area. Becoming a successful investor requires continuous learning and updating of knowledge. In the investment world, those who act with solid knowledge and strategy emerge profitable in the long run. Options are significant tools in the investment world and can be used to manage risks on stocks. Put options allow investors to limit the devaluation of their stocks. Suppose you purchased ABC Company's shares at $25 and worry about a price drop. In that case, buying a protective put option can safeguard you. This option gives you the right to sell at a certain price if the stock price drops, and you pay a premium for this right. To explain with a real-world example, you bought a stock at $25 and its price fell to $10. Thanks to the protective put, you can still sell the stock at $25, thus avoiding significant losses. This situation is akin to insuring your stock investments, allowing you to enter the markets with more confidence. Such strategies can be particularly valuable for investors during periods of high market uncertainty. Many people have withdrawn from the markets after experiencing significant losses in the past. However, Tools like protective puts can alleviate these fears and provide investors with more confidence. This way, investors can protect the value of their savings and achieve their financial goals in the long term. Bill Kraft explains the protective put strategy as an effective way to safeguard your investments. This approach is like adding an insurance policy to your stock investments. For instance, by purchasing a put option on the iShares Russell 1000 Growth Index ETF, you can minimize your losses if the stock price drops. With these protective puts, even if the value of your stocks decreases, you retain the right to sell at a certain price, thereby protecting yourself from significant financial losses. Consider the example of Enron's bankruptcy. During that period, many investors suffered large losses. However, investors employing the protective put strategy could have avoided such losses. This underscores the importance of risk management in the investment world. Option prices vary based on factors like the expiration period and the volatility of the stock. Options for longer-term or more volatile stocks may be more expensive. However, this cost can be viewed as the price of protection against significant losses. When investing, considering such risk management strategies can help safeguard your financial health in the long run. This text discusses ways to protect yourself and make profits in the investment world. Put options are attractive tools for investors who believe stock prices will decrease. For example, if a stock's price drops, a previously purchased put option gains value. This situation allows the investor to sell the option at a higher price, thus making a profit. To illustrate with a real-world example, an investor made a significant profit in a short period by purchasing put options on Whole Food Market's shares. Such strategies can be effective for those who foresee a decline in stock prices. Additionally, the strategy of selling naked puts is also discussed in the text. This strategy involves selling a put option without owning the underlying stock, and although considered risky, it offers profit potential if used correctly. The key is being aware of the risks involved and carefully evaluating the investment's potential returns. Strategies like put options and selling naked puts offer investors the potential for both protection and opportunity amidst market fluctuations. Naked put selling is an intriguing strategy in the investment world. In this approach, traders take on risk for a certain premium, provided the stock price doesn't fall below a certain level. For example, if you want to buy XYZ stock at $35 per share, the market pays you a $1.50 premium for it. In this case, your net cost per share is 33 to 50 cents, which is a less risky position than buying directly at $35. However, this strategy requires serious experience. Selling naked puts demands that you be an advanced level investor and maintain a certain account balance. After the 1987 market crash, brokerage firms imposed stricter rules for such transactions because many traders took on excessive risk and suffered significant losses at that time. For instance, you can take short positions in stocks like Phelps Dodge, using this strategy to earn profits without making any investment. But as with any investment strategy, it's essential to analyze risks and market conditions well when using this method. Remember, with the right strategy and knowledge, it's possible to minimize risks and generate profits. In this section, Bill Kraft details how to profit from low-risk trading strategies, particularly with put options. The naked put selling strategy can provide high returns to investors when applied correctly. For example, even if a stock's price drops, as long as it doesn't fall below a certain level, the premiums earned from sold put options remain with the investor. This offers the investor a 2/3 chance of making a profit. However, naked put selling also carries a significant risk. If the stock price drops too much, the investor may have to purchase the shares. To reduce this risk, Kraft suggests the spread strategy. A spread involves selling one put option while simultaneously buying another put option with a lower strike price. This method limits potential losses while still offering the investor a good return. For instance, while making a $50 sale, buying a put at $45 can limit the risk to $5,000, and the premiums received can further reduce this risk. The most important lessons from this book are: 1. Financial independence is not solely achieved through high-paying jobs. Personal initiative in investing is crucial. 2. Overcoming fears and managing risks are key to financial success in trading. 3. A disciplined, well-planned approach to trading can lead to achieving financial goals. 4. Risk management is vital. Understanding your risk tolerance and crafting appropriate strategies is essential. 5. Technical analysis can help eliminate emotional decision-making in trading. 6. Using protective strategies like put options can safeguard investments against significant losses.